Today's guest, Sebastian Schilling, fractional CFO and COO for post-Series A startups.
Let's look at the probably most basic financial KPI, revenue, right? So depending on who you talk to in the company, if it's the data team, if it's the founder, if it's the salesperson, if it's the FP&A person and the accounting person, they might give you 5 different answers for what they consider to be revenue. Now, at some point, and nobody likes to hear that post-Series A, at the end of the day, the accounting person is right. Because that is what your auditors, the definition of revenue that your accounting person is going to give you will be the one that your auditor is going to hold you accountable to. And your board isn't going to notice. They will swallow whatever revenue figure you give them, but when your audited revenues are 10% lower than what you've been reporting, you're in for a very unpleasant conversation. It's always one that can be explained, but at the end of the day, when you talk about revenue, the accountant is always right. And it makes sense, therefore, to agree on a definition of revenue between the data team, the FP&A team, the founders, and the accounting team very early on, and take the number that the accountant wants. It doesn't mean that you shouldn't track other figures, right? Like gross bookings or revenues before discounts, or sales before discounts. But ultimately, the revenue number what you call revenue should be what ends up on the top of your financial statements later on. One mistake that I've seen people make is to hire really good individual contributors and promising them a management role 18 months from now. And that would work in terms of your org chart, but it might not work in terms of having that person. Because that person's growth trajectory might just look incredibly different. And maybe 18 months from now, they still need another 12 months to grow into a leadership role. And then they shouldn't be in charge of a team. So my biggest advice would be very careful with making promises to especially junior people that start in terms of promising management roles.
Sebastian and I talked about the journey from a finance team from Series A to Series D and how to grow a team, and also certain processes like headcount planning, how it evolves. So quite relevant for any CFO founder that needs to build finance teams or recruiters, HR people, whoever that is has touch points with finance.
Then you can build trust, and then you can spend less time communicating and more time just getting shit done.
Then I went home and thought about this sentence.
We basically put it on the table.
Hiring takes time. People are trained.
How to objectively judge certain situations.
It's very, 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 very hard to change things.
That was the learning.
Entrepreneurs with empathy.
To the people side.
Oh, I'm really looking forward to this episode because Sebastian, we both worked together and it was always a pleasure. And now we are sitting here doing this episode. So maybe we start about with some context about you, and welcome to the show.
Thanks, Thomas. Also, likewise, very happy to be here. Thanks for having me. What do you want to talk about today?
Yeah, maybe tell us a bit about your background first, and then we talk about some finance topics, and also I think some topics between interactions over time in a company between finance and the people team. But let's first give us some context about your journey.
Okay. So what I'm doing today is I'm helping companies grow from Series A to Series D, basically building up their finance and their people functions internally. So that's what I'm doing today. And the last 4.5 years, I've been basically doing exactly that at TaxFix, building up the finance, FP&A and accounting functions, as well as the internal operations functions, consisting of internal IT, office management, and people operations.
And before you joined TaxFix, you also did a lot of interim finance deals, right?
Yes, I was the CFO for Cive, a data advertising company based in Berlin. And before that, I've been working in various CFO, COO roles, mostly interim.
Yeah, and also in the Rocket Internet time, right? But there was
we have crossed
going on. And how did you get into finance?
That's a good question because I'm actually a lawyer by training, so I'm not really in terms of academic background, not the most typical finance person. I also studied economics, which means I've had some exposure to to numbers, which always helps. But I've been mostly when I started out my career, I've been helping out founders with basically their entire paperwork, and that very soon became not only shareholder agreements and board meetings, but also business plans and Excel models and spreadsheets. And then it didn't take long until, for some odd reason, I was offered a CFO role.
Nice. And when we now start maybe categorizing the journey of a finance department or finance as a function in a startup, let's say from Series A to Series D, maybe we go into each round, and you can give us some perspectives on what you think is important and also how you would define a certain stage in a company from a finance perspective.
It's a very interesting topic. Probably might even go beyond the scope of the hour that we have together today, or half hour, right? Post-production. So we're basically talking about entirely different companies. If you're talking about a company post Series A versus a company post Series C, so it's, they don't really. It may have some overlap in terms of the people that work there, but and the name. That's about it when you talk about finance and people functions. So so a lot of the groundwork is basically done by the founders before they even raise a round, right? So the question is a founder at all doing anything beyond the bare minimum, which is having a bank account? So do you, as a founder, when it's just you in the beginning and maybe your assistant or whoever else you have, do you make sure that at the end of every month, every bank transaction has some sort of record attached to it? So that is the first question. So if a founder hasn't done that, then the first thing you do post Series A is to clean up the past, which is a shame because you're not delivering any value to the business. You're just making sure that you don't carry on management debt forever. And that can easily cost you 3 months worth of your time. So a lot of the groundwork is actually being done before. If you join a company like Taxfix was, where the founders actually always were really, really keen on having meticulous finances in place, then it's a bit easier because then you can basically start right away to adapt processes.
What would be the groundwork?
The groundwork is basically just making sure if you get a bank statement at the end of every month and you make sure every line item on that bank statement has some record to it, right? So it's not just the bank transaction, but there's actually a receipt, like an invoice. Or
somewhere in the Google Drive folder, for instance?
Doesn't matter, right? You don't even, if you, it's enough if you just scan it, right? That's perfectly fine. Just have it and make sure you can retrieve it at some point. And then if you send that off to an external tax advisor, which is what most startups do, and which is perfectly fine, then that usually takes care of everything pre-Series A. So let's assume you come into a startup that's been doing that. You come in on your first day, as you take a look, you see, okay, everything seems to be in order. There haven't been any external audits yet, or if there have been any, there weren't any findings. You call up the tax advisor, they tell you everything's okay, and that usually gives you enough comfort. So post Series A, why is post Series A so interesting? Because that's usually the round where investors invest a meaningful amount of money into your company.
Like plus 5 million, plus 10 million? How would you define it?
Let's say, so I define Series A as you have some early proof points that there might be product market fit. And
like
you've built
first revenues, you would say?
You would have to have first revenues, I would say. And it depends. I mean, there are also some apps, for instance, that are free, right? And then but you have some traction at least, right? You have showcased that you can, in principle, invest money in marketing or sales channels, and that has some degree of results and promising results that will enable you, at least on a spreadsheet, to build a profitable business case. Spending money, getting more money back eventually. I'd say that's
in the future.
At some point in the future, right? And that obviously, how long that future is depends on the market. It's much shorter now than it was 2 years ago.
Yeah.
I would say that's how I would define a Series A. Series B would then be, you've proven that works at scale. So now an investor comes in and gives you even more money so you can increase the scale. And Series C, Series D, you basically leave the realm of venture capital and go into growth equity, where it's an investor really investing in the business as a whole and not just some acquisition channels.
In case you like my show, please subscribe. I would really appreciate it. And when would you recommend going for a debt round rather than going for equity funding?
That really depends on both the business model, the market, and your maturity as a company. So I think debt is always a really good idea to have alongside an equity round because it's non-dilutive. You're not giving away too many shares, which is great. But definitely don't do debt just for runway extension when you're struggling with your fundamentals, right? If you know that you're basically running out of cash and you add a debt round to extend your runway, then that's a really bad idea because
it's
borrowing happiness from tomorrow.
Yeah. Yeah, I remember you said that also once when we worked together at TaxFix. It's also like drinking, right? Drinking is
borrowing happiness from tomorrow. That's what it is.
That's a nice example.
As is letting your kids stay up late. It's the same thing.
Okay, so how does the finance team look like in these different stages? So how would you set up a finance team in a Series A environment versus B, C, D?
Yeah, so you always have to square a circle a bit between hiring the people for the task that you need today, but also already hiring the people that you need for tomorrow. So basically finance you can split up into two, especially Series A, you can split it into two larger functions. One is operational finance, accounting, and the other one is strategic finance that evolves around mostly financial planning and analysis, FP&A.
Nowadays, you don't call it controlling anymore, I guess.
Controlling is like handy. It's a German word. It doesn't really exist.
Okay.
In the English speaking world, it's always been FP&A.
Okay. No, I just sometimes hear different terms.
Yeah. It's still a thing in Germany. You can't get rid of it. But let's call it FP&A for future reference. So they're basically two vastly different skill sets. Right? You shouldn't get an FP&A person to do accounting; they'll get bored, and you don't want an accountant to do FP&A because they will think about your unit economics fundamentally different than an FP&A person would.
And also, it's a different time horizon, right? Accounting is more towards the past, and FP&A is more looking into the future.
That is a way of looking at it. Although an FP&A team will also always look towards the past, but assess it with from a perspective that includes the future impact. Mm-hmm. But they will always also look at actuals, of course.
Also, accounting or operational finance is way more on processes oriented, right? Like getting maybe.
Actually, both are. Also, FP&A has to be process oriented, right? You can't reinvent the wheel every day, right? So you have to agree on a certain terminology, also with your data team, and this FP&A is probably the more complex function to start with, because there's also a lot of build-up work to be done, because you're working with a data team that's also going to be very new in a Series A company. You will work with founders that have probably thought about metrics in a different way than your financials did. And here's probably the first thing where it makes sense to have the two work closely together, although they're different. when you look into the future. So let's look at the probably most basic financial KPI, revenue, right? So depending on who you talk to in the company, if it's the data team, if it's the founder, if it's the salesperson, if it's the FP&A person and the accounting person, they might give you 5 different answers for what they consider to be revenue. Now, at some point, and nobody likes to hear that post Series A, at the end of the day, the accounting person is right. Because that is what your auditors, the definition of revenue that your accounting person is going to give you will be the one that your auditor is going to hold you accountable to. And your board isn't going to notice. They will swallow whatever revenue figure you give them, but when your audited revenues are 10% lower than what you've been reporting, you're in for a very unpleasant conversation. There's always one that can be explained, but at the end of the day, when you talk about revenue, the accountant is always right. And it makes sense, therefore, to agree on a definition of revenue between the data team, the FP&A team, the founders, and the accounting team very early on, and take the number that the accountant wants. It doesn't mean that you shouldn't track other figures, right? Like gross bookings or revenues before discounts, or sales before discounts. But ultimately, the revenue number what you call revenue should be what ends up on the top of your financial statements later on. And so this is just one example of where it makes sense to have very, very close alignment between a number of different teams.
The definition of revenue, you said that there is a high importance on aligning how to define revenue, right?
As with any financial KPI.
And this should happen in Series A, you would say?
So you don't have to do it in Series A. At TaxFix, we had vastly different definitions of revenue and sales for a number of years. It's just, if you do it early, it's much less work than if you do it later. There's actually many examples of what's less work when you do it early stage, even though it might appear to be over the top. Having a multinational accounting system, something that we implemented very early on at TaxFix, something I did during my first 5 months. And it was so cheap compared to what other startups pay if they implement an ERP system or a larger accounting system post Series C. And also there's no right or wrong answer. It really, again, depends on the business model. If you have commerce and you have actually physical goods that you ship, you should definitely have an ERP system as early as possible. If you have a software business, you can probably IPO with your financial in Excel to overstretch it a bit. So it really, really depends on the size and the nature of the business.
And when would you grow the team of, let's say you have the FP&A arm and the accounting arm, and when you go to Series D, for instance, usually you have maybe a headcount of, 500 to 1,000 employees. How should the finance team look like then? And how would you grow it over time?
Yeah, it also... So there's no right or wrong answer when it comes to size of the finance team. So at TaxFix, for instance, we had completely outsourced accounts receivable to an external service provider, which was a great decision because accounts receivable we never had to worry about. That is typically a team that, if you have it in-house, it would have easily doubled our headcount in the finance team. Right? So I can't give you a number because it depends on which parts of your financial operations you have outsourced. If you have a B2B business, on the other hand, where you basically just have a few blue chip clients that you might have to chase every once in a while, you can probably make even more revenue than TaxFix does, but with much fewer people taking care of the bills. So it really, really depends on your business model. So I suppose what you have to do post Series A is, first of all, you have to build up 2 functions. One is the strategic finance FP&A function and the operational finance accounting function. And then the challenge is to find people that do heavy lifting, but also have the mental bandwidth to advise and be a business partner to the founders and the rest of the business. And that also extends to you as a finance manager, that it's basically 2 full-time jobs in terms of mental capacity to worry about building a team and building systems and building procedures and aligning them with the rest of the business, and having that high-level view of what your unit economics and your financials look like, and being a business partner and advisor to the founders. So these are basically, they're 2 full-time roles already, and you basically have to fulfill them both in a way. It definitely makes more sense to invest. I believe it makes more sense to invest early on in building structures, so you actually have something to build on and to advise on. That would be my prioritization. When you look at the team, I think it's probably a challenge most managers in fast-growing companies have. You have to find someone who completes the tasks that are required on a day-to-day basis, but who also have the capacity to build up a team themselves. Right. So the question is: do you hire a manager very early on, or do you hire a promising, talented individual contributor? And one mistake that I've seen people make is to hire really good individual contributors and promising them a management role 18 months from now. And that would work in terms of your org chart, but it might not work in terms of having that person, because that person's growth trajectory might just look incredibly different. And maybe 18 months from now, they still need another 12 months to grow into a leadership role. And then they shouldn't be in charge of a team. So my biggest advice would be very careful with making promises to especially junior people that start in terms of promising the management roles. So I would probably hire a really, really good individual contributor to start with in the very early beginning, and then see and monitor and coach them very, very closely if they have the potential to build up a team among themselves, or whether they are more suited to stay in the individual contributor role, and then hire a manager next to them.
And at some point, you also need to maybe go into fundraising, and early on, it's maybe way more founder driven. But at some point, I think the finance team gets way more involved, because I also saw roles like investor relations at some point, or people doing or being way more involved in fundraising. I think you also were heavily involved in Series C, Series D rounds. And how does this then look like?
But I supported, and I wasn't external facing. So, and I would always refuse such a role unless it were my own company, because up until very shortly before an IPO, investors would usually want to talk to founders. Every once in a while, I get a request from founders that want me to help them raise their Series A round or even B round, and I always refuse that, because I say, I can help you with your spreadsheets, I can help you with your presentation, but you have to be the one that does the outreach. No one's going to invest in me. Everyone's going to invest in you as a founder. And if you don't take fundraising seriously and you can fully own it, no one's ever going to invest. You can't outsource that. So yes, you should have a strong finance team that will support you in your fundraising, but no finance team in the world is going to do fundraising for you. Not before an IPO roadshow. There's no reason to rock up with any finance executive as a founder. Your CTO is going to be much more interesting, because your investor is going to invest in technology, not in financials.
Makes sense.
In case you have any feedback or anything you want to share with me, please send me an email on thomas@peoplewise.com or hit me up on LinkedIn. And in case you really enjoy the show, please subscribe. I would really appreciate it.
And let's say now the finance team is established, business as usual is running, you're efficient, and then you need to get more collaborative and maybe proactive overall in forecasting and so on. And at some point, other departments are involved. And I name one, for instance, the people team, when it especially comes to headcount planning, also the managers. And I see that all companies that go through that growth journey, they have problems with headcount planning at some stage. Maybe we dive a bit into the headcount planning piece from a financial perspective, also from a talent acquisition perspective, and from a manager perspective. So how do you see headcount planning evolving over Series A to Series D, let's say, from a financial perspective?
I don't, first of all, because headcount planning is just counting people. It's really not that hard. But why does it go wrong so often? In what I've seen go wrong in the past is basically misalignment of different data points in the people journey. Right? So the question is, if you have 50 people, you know everybody, and you can basically calculate all the exceptions that you may have in your head. If you at any given time ask a manager to do headcount planning, and you don't give them an exact data set, they will all have different reference points of how many people they have in their team, because there is people who are on extended sick leave, who are on paternity leave, who have not started yet, who have terminated already, who will go into 75% part-time next month. So it's a different question to start with. Are you working with heads or are you working with FTEs? Are you working role-based? And up to which point do you count roles that have already submitted their resignations? Do you count the actual resignation, or do you count the effect of the resignation? And do you count somebody who has already signed but hasn't started yet? And when you start the process and you finish the process 2 weeks later,
it's different.
The time references have already shifted.
Yeah.
So across the organization, you're talking about vastly different data sets. If you don't get that meticulously right, and at the end of the day, it's not really a process question so much as it is a data question. So the question: how many people are in your company at any given time can be answered in vastly different ways, depending on who you ask, when you take a look, and how you cut your data set.
Yeah, exactly. Especially the dimensions on how you plan, right? How do you cut an org? What is a department versus maybe a division, a group, a country, a team,
a mission,
a sub-team? Yes. Especially, for instance, what I see, right? There is sales, and sales maybe plans more by region, yeah? And then there's the tech and product team, and they plan more by, as you said, mission, or they give some fancy abstract term. One works on platform, one works on the actual product, one works on another piece of the product, and so on and so forth.
And then you have finance that plans by entity.
Exactly. And for hiring or for talent acquisition, this is usually a problem, because what I see, that talent acquisition teams are set up more sophisticated and more capable in terms of delivery and the standard processes that they're running. Because if you're at a stage of maybe 150, 250, 300 people, you probably hired 500 into the organization until then, right? So there is a lot of proof of concept that the recruiting process works. But early on, when you just have 100, 150 people, the whole people infrastructure with the whole systems, as I said, how to collect data, it's not complex. Yeah, it's usually a spreadsheet or a simple tool, and that's it. But when you get bigger and have more dimensions in terms of markets, countries, departments, and change that is not happening in parallel, but okay, now there is a new CTO hired and the CTO is restructuring. Now we have a new sales leader and the sales leader is restructuring. Things get lost. And the original definitions and the original assumptions less reflect reality. And at some point, you get then ad hoc requests, and the organization faces a peak in terms of what's needed to deliver. Usually Q1, after the budget planning ends. And then the talent acquisition team is overwhelmed. What do you think can managers, finance teams, and talent acquisition or people teams do to prevent this?
So I think the first one, my first order of business as a founder of building my org would be to have one person in the beginning take care of both the financial side and the at least the people operations, possibly also the talent acquisition side. Learning and development, org culture, that is something that you can have a specialist on. I think that can even make sense. But from the purely operational functions, talent acquisition, people operations, it really makes sense to have these processes very, very closely interlinked and, if possible, set up jointly. Very simple example: if you hire somebody, they'll talk to someone in the talent acquisition team. They will collect certain data points like the position, the salary, the name, the address, the stock options, and they will then pass that over to the people team. And then if these processes don't work well together, the people team is going to ask the candidate exactly that same question again. And then at some point, the candidate wants something from the finance team. The finance team works again in a different system. They're going to ask the same questions again. And let's not get even started with IT, right? So it really makes sense to have this entire journey of where does an employee or a candidate interact with a company, and how does the company process the data, and how does it store them and classify them, to set that up sort of from a holistic perspective. That is probably the most important piece, I would say. And the same goes for dimensions, right? So I've worked in a company where this was set up jointly together, and then the people in the finance team had exactly the same dimensions, right? There were different departments, right? And at some point, people team got separated, and they came up with these entirely different dimensions. At the end of the day, the department dimension still existed, it was called differently, and it's just created so much confusion. And I think having this, also the tools in different across the different departments set up in a joint way, right? You set the applicant tracking system, that you set it up in a way that it directly feeds into the HRIS, and the HRIS feeds into your payroll provider in a way, and the payroll provider actually supplies an export at the end of every month that integrates directly with the finance system, so you don't actually have to manually book payroll. That really makes sense, but it won't work if you have a different manager for each of these teams. And one other thing that I think can really, really help is something that we also do in accounting is a monthly close, right? At some point, we just say, this is the month. Everything that has come in, every receipt that has come in until today will be booked in the past month, and everything that comes in afterwards is going to be booked in the next month. Yes. And to have that in the people operations team and just say, we're going to close the month today. All the other terminations and resignations that happen until now will be counted in the past month. Everything that happens in the future is going to go into the next month. So at the end of this month, we had exactly this many people. Right? And if I look back in the past and I say, how many people did we have at the end of October 2021? I just look in some PDF that's stored somewhere, and I can say, this is how many people we had. And the definition of how that's counted never changes. This is the way the finance team does it, and this is also something that the people team could do, and it would really, really help in just getting being able to reproduce the same information over and over again.
Yes, definitely. And what's now next for you, Sebastian?
What's next for me is I'm going to build out my own company that will, like I said, help companies grow finance and people teams post Series A. I will do that with hopefully a few more consultants that work closely together with me, and that I will do that for more than just one client.
Yes. Nice. And who is a guest? Did you know? I don't know yet who I should interview next.
So I don't know. You should interview next. You've already talked to Marie from TaxFix, right?
Yeah.
She was great. Have you talked to Aki from TaxFix yet?
Yes.
Also, Jesus.
You can also just, once you have something in mind, send me a
I will.
message.
Then I can always can maybe put you in touch with Lexi from Finoa, who's also fantastic.
Yeah, maybe.
Yeah.
Cool. Sebastian, was really nice talking to you. A lot of value here, especially on the finance side, on how to ramp everything up. So was a pleasure talking to you, and have a great weekend.
Thanks, Thomas. You too.